Commissioners for Her Majesty's Revenue and Customs against DCC Holdings.
Mr. Garden.
My Lords, may it please you, I appear in this case with my learned friend Mr. Walford on behalf of the appellant DCC Holdings UK Limited, who I shall refer to throughout as DCC.
Yes.
And my learned friends Mr. Furness and Mr. Gibbon appear for the respondents, the Commissioners of Her Majesty's Revenue and Customs are referred to as the Revenue. Well, insofar as I'm able, I'd like to develop our argument in the same order that it's dealt with in our written case, but I do have three preliminary points to make.
Can I make a point?
Well, yes, absolutely.
I'm not jumping in too quickly.
Yeah.
I think that the Lordships would appreciate being taken fairly gently through the legislation, because while we understand the transaction, which is fairly straightforward, finding one's way through the legislation is a complicated process. And speaking for myself, I haven't found a very easy guide in your own written case as to how you would invite us to do this. And it might be helpful if you would just give us a kind of tutorial working through the legislation so that we can just see how you say it fits together and identify the really critical words in the relevant provisions, because obviously some are more critical than others. Could you?
I'm perfectly happy to start with the legislation, yes, and let me take it then from the Authorities Bundle. It's an Authorities Bundle, Volume 1. And behind tab 1, and this is set out in a reasonably logical order, and it's one hopefully can make this point, that we are concerned with the taxation of companies post-1996.
Yes.
Prior to 1996, individuals and companies were treated in the same way. And all the legislation actually that was relevant to loan relationships, we'll see here in Schedule D, Case 3, simply referred to interest of money and discounts. Capital gains tax was a separate tax in respect of gains that you might make, but the actual statutory terminology that was applicable to both corporations and individuals, we'll see if you look at the first tab, if one looks on the second page, at the top of the page, 1047, Case 3, under subsection 3 of section 18, tax in respect of any interest of money, whether yearly or otherwise, or any annuity or other annual payment, whether such payment is payable within or out of the United Kingdom, either as a charge or any property of the person paying the same, by virtue of any deed or will or otherwise, or as reservation out of as a personal debt or obligation, etc. And then B, all discounts, and then C, income from securities which is payable out of the public revenue of the United Kingdom or Northern Ireland. And there weren't any elaboration provisions as far as that is concerned. So essentially, the charge was just on interest and discounts. And that remains the situation for individuals. But post-1996, we have a major change in the law brought in by the Finance Act 1996 as far as companies are concerned, corporations. And you'll see that in section 3A, which is on that page, just after Case 6, 3A, for the purpose of corporation tax, subsection 3 above shall have effect as if the following case were substituted for cases 3 and 4. That is to say, Case 3, tax in respect of A, profits and gains, which as profits and gains arising from loan relationships are to be treated as chargeable under this case by virtue of Chapter 2 of Part 4 of the Finance Act 1996, then any annuity or other annual payment which is not concerned with, and then see any discount arising otherwise than in respect of a loan relationship. And as if Case 5 did not include tax in respect of any income falling within paragraph A of the substituted Case 3.
And we read that with note 6, which tells us when this came into effect.
My Lord, yes. And that is the Finance Act 1996. So what that means is that as far as a company is concerned, if and insofar as it has a loan relationship, whether that loan relationship is in the United Kingdom, is in the Bahamas, or wherever it is always taxed under the regime of the Finance Act 1996. And the charging provision is Case 3 of Schedule D, as substituted by that section 3A of section 18. Now, that's the charging provision. And it might just be helpful to say this, that what they've adopted is consonant with the general scheme of taxation in this country of identifying a source of income and then income from that source. And the source is the loan relationship. This rather unwieldy term that we've all had to live with for the last 14 years, but that is the source. And then one has got to look at the income arising or the losses arising in respect of that loan relationship. So rather like in my position as a member of the bar, I'm taxed under case 2 of Schedule D, and that is because I have a profession, and that is a source of my income, and that is effectively what's taxed. And here, for these purposes, is the loan relationship. Now, if I might then go on to more relevantly to the facts of this particular case, behind tab 2, we have the first of the repo provisions, which is section 730A of the Income and Corporation Taxes Act 1988. And if I hope, helpfully, if I indicate, now, there is no dispute. Sorry,
to be quite clear, 730 is 730A you're looking at, isn't
yes,
it?
my lord, yes.
Yes.
It's the bottom of the page, 730A. So it's on page 1697.
Yes.
At the end of the page. And I'll take your lordship through these terms, but could I just explain at the outset, because I think this would be helpful. There is no dispute between my learned friend and myself as to the application and the consequence of this particular provision. What this provision does is come to a result which is equal to the result that the company in its statutory profit and loss account comes to by adopting appropriate accounting principles. It might just be helpful if I did refer to the figures in this context. On the facts, very simply, DCC bought gilts on our aggregate illustrative transaction for £812 million. It resold them for £785 million. And whilst holding them, it received a coupon of £28.8 million. And what the accountants do in the statutory accounts is simply to look at those cash flows. And they look at those cash flows and they treat the transaction as if DCC made a loan to X Bank of £812 million and made a profit or interest being the difference between those cash flows. And the lordships will instantly realise, just in those simple figures, DCC received £785 million and £28.8 million. That makes £813.8 million. And that is in excess of £812 million. Therefore, it made a profit of £1.8 million.
Yes.
So that is the accounting treatment, whereby the accountants say, even though you haven't made a loan, the substance of your transaction is as if you had made a loan. We will treat you as making a loan, and the accounting treatment, therefore, is to give rise to a profit and loss item of 1.8 million of interest in the profit and loss account.
And that's agreed, as you say.
That one is agreed.
That's the easy bit.
Yeah, absolutely. But this particular provision, 730A, achieves precisely that result, but by a somewhat different route. But at the end of the day, the result of section 730A is to bring into charge precisely the economic profit that the accountants recognise in the statutory accounts. And this is an extremely important point, because what is said on the other side and is said below against us is that the purpose of all these provisions is simply to get you to a result that equates to the economic result in the accounts.
That would be so if 730 stood alone, 730A stood
My
alone.
lord, that's right. And that's the point I'm simply making here, that purpose and objective is achieved entirely by this particular provision. That purpose and objective cannot have been the purpose and objective of the other provisions that we have to look at, because it's entirely exhausted and satisfied by this provision. And the other provisions we have to look at, obviously I take your lordship to the road, is the ordinary loan relationship represented by the gilts, and then the other fictional loan relationship created by the statute, which is 737A. And that's what I want to say. Now, if I can then go to the terms of 730A, but that's its significance, and I hope that was just helpful to indicate that. So if one looks at subsection 1, subject to subsection 8 below, this section applies where a person, the original owner, has transferred any securities to another person. So X Bank is the original owner, the other person is DCC, he's called the interim holder, under an agreement to sell them.
Just one second.
And then B, the original owner or a person connected with him is required to buy them back. And either one, in pursuance of an obligation to do so imposed by that agreement, or by any related agreement, or in consequence of the exercise of an option acquired under that agreement or any related agreement, and C, the sale price and the repurchase price are different.
Yes.
So that is the nature of the transaction. Commercially, we have a transaction whereby there is a sale for 812 million and at the same time an agreement to sell back at 785 million. And then 2 says the difference between the sale price and the repurchase price shall be treated for the purposes of the Tax Acts. A, where the repurchase price is more than the sale price, as a payment of interest made by the repurchaser on a deemed loan from the interim holder of an amount equal to the sale price. Now we just pause there. Where the repurchase price is more than the sale price, on our actual facts, it isn't. But there is a further deeming by section 737C, which adds on to the repurchase price the amount of the coupon.
That's brought in by subsection 9, is it?
My lord, yes. Yes, my lord, you're absolutely right, yes. I'm also going to show you that, but at this stage it's just saying that for our purposes 2A is the relevant provision here,
right,
because the coupon is added to the repurchase price.
And that's a combination of subsection 9 and 7.3.
7C, my lord, yes. I'll show you, lordships, all the provisions, but I hope I'm trying to demonstrate how they apply at the moment. So 2 then says the difference between the sale price and the repurchase price, and on my simple figures, therefore, the sale price was 812, the repurchase price is now 785 plus 28.8, and that gives you, therefore, the repurchase price being 1.8 million in excess of the original sale price. And it is that, I'm sorry, it is that difference, the difference, as one shall see, shall be treated as a payment of interest made by the repurchaser, that's DCC, on a deemed...
I'm sorry, could you just repeat that? The difference is...
The effect is that there is a payment of interest made by the repurchaser, and I'm sorry, that is X Bank.
Yes, it surely must be X.
X Bank, my lord, yes, I'm sorry, it's
because of
the
the
tongue,
results
yes.
of the things
Yeah.
we're looking at, yes.
It's X Bank.
Is there any possible reason why we should call Ulster Bank X Bank?
The only reason, my lord, is this, that before the special commissioners, there's a rule of the repo market that the parties have to actually keep their identities confidential one to another. It's a rule of the contract entered into in this case. That was why that point was made before the Special Commissioners, and the Special Commissioners accepted it. That's the only reason for it. I mean, I'm entirely content that X-Bank should be called Ulster Bank, I mean, as it is. That's the only reason for it.
In a way, it doesn't matter
No.
who the bank is.
No,
from
it could have
the
been
point of view
anybody.
of your position.
Yes.
It doesn't. I just don't want, if there is any suggestion that Ulster Bank is entitled to anonymity, I'd be interested to know why.
Yeah.
But
Well,
you've told us the
Yeah,
reasons.
that's the only reason. It's a contractual one between my clients and Ulster Bank. It's a rule of the market. That's all.
Thank you.
And obviously that would have to give way to any decision of any court. I mean, the parties obviously have to accept that. So my clients were simply trying to comply with their contractual obligation as regards the counterparty. So going back then to 2, the difference, so that's the interest of 1.8 million, shall be treated for the purpose of the Tax Acts whether the purchase price is more than the sale price as a payment of interest made by X-Bank, Ulster Bank, on a deemed loan from the interim holder being DCC, of an amount equal to the sale price. So there is a deemed loan of 812 million on which interest of 1.8 million accrues. And that is a deeming for the purposes of the Tax Acts. So that when we come to look at the loan relationship provisions, we've therefore got a loan deemed by this particular provision that constitutes a loan relationship and interest flowing from it. And then B is not applicable here, it's the other way around. Where the sale price is more than the repurchase price as a payment of interest made by the interim holder, so that would be going the other way, DCC, on a deemed loan from the repurchase of an amount equal to the repurchase price.
So we're in subsection 2A.
We're in subsection 2A, my lord, yes. Because the coupon is added to the repurchase price. And then 3, where any amount is deemed under subsection 2 above to be a payment of interest, that payment shall be deemed for the purpose of the Tax Acts to be one that becomes due at the time when the repurchase price becomes due, and accordingly is treated as paid when that price is paid. And could I just pause here? The terminology is important in our respectful submission, and we'll see the like terminology in 737A. But what these provisions are recognising is that the repo itself is not actually a loan as a matter of law. Forgetting tax law, one simply got a sale by one person, an agreement to sell back by another person. That, as a matter of ordinary law, does not constitute a loan. The statute, however, is seeking to tax it as if it were a loan, giving rise to interest income. I mean, also that's an important starting point, because the genesis of these provisions is basically this, that these transactions can be entered into between, on the one side, an investor who would ordinarily be subject to capital gains tax, and on the other side, a financial institution, a trader, or all of whose activities would be taxed as income. If one thinks about the ordinary legal effect of the transactions, a sale by an investor, that is for a capital sum. A purchase by an investor with a repurchase may be a transaction at a capital sum. That would prima facie, in the case of an investor, be something liable to charge as a capital gain. Capital gains are treated more leniently, even nowadays, in our tax regime, but certainly at the time of the enactment of these provisions, than income transactions. The purpose of these repo provisions is to transmute what would have been capital transactions into streams of income so as to tax them for the benefit of the revenue. And that's true of 730A, and it's true of 737A. And one can get from the legislation that that is its purpose, not only from the terminology and the difference I've just referred to, but if you see the heading of this part of the Act, it's under tax avoidance. Now, people have different views about tax avoidance. You'll see it at the top of page 1697. This part of the Act is all tax avoidance.
Sorry, I haven't found.
At the very top of page 1697, just above where it's set out sections 100 and 730,
yes.
you see the heading at the top.
Oh, I beg your pardon.
Right
Yes,
at the
I
very
see.
top of the page.
Yes.
Yeah.
And that's in the statute.
That's in the statute. The
Where
whole
does
of
that
this
begin?
part.
Where does that begin?
Where does it begin? There are vast
Yes.
numbers of provisions on tax avoidance, my Lord. I'll give you the answer after the lunch adjournment, but
Yes.
there are thousands of pages in our legislation under the heading of tax avoidance. This is simply part of them. But the point is this, well, one can argue about what is tax avoidance. So for my part, the only acceptable definition I believe that one can justify these particular provisions is that you have a transaction, the legal consequences of which the revenue or Parliament in its wisdom doesn't like and wishes to convert to something else. That, therefore, is deemed to be tax avoidance. Now, that is the explanation for this, that they didn't like a repo transaction because it gave rise to capital gains, chargeable, as far as an investor is concerned, under the regime of capital gains, and therefore they create streams of income to replace it.
But on any view, this is an artificial transaction, isn't it?
In substance, there is no doubt what the accountants say is correct, that in substance it is the equivalent of a secured loan. There's no doubt about that. But I'm saying, as a matter of legal analysis, it isn't a loan. As a matter of legal analysis, it is a sale and a repurchase. And this particular provision says that if you've got that, we will deem it to be a loan, and we will deem there to be interest from that loan. So that's deeming there to be a fictional legal consequence different from the ordinary consequence of the transaction. That's only the point I'm making. But
though it is in substance a loan in commercial terms.
in commercial, well, absolutely, yeah. And that's why the accounts, I mean, the accounts apply FRS 5, which is headed accounting for the substance of transactions, and it says in terms, you disregard the legal form, you account for the transaction in accordance with its commercial substance.
So far, we haven't got into the problems created by the coupon and the treatment of the coupon.
No, Lord, no, we've got to go
later.
on. Yes, I'm sorry, perhaps I'm going too slowly on.
No, I don't want to move you any faster than you're going, please.
No. Well, let me go on, because I've got to the main thrust of what this provision is about. The point, it then makes the point that I've already made in subsection 3, that the payment of interest becomes due at the time when the repurchase becomes due, so they provide with that consequence. And then the next provision here of significance is subsection 6, and that says, for the purposes of chapter 2 of part 4 of the Finance Act 1996, loan relationships, interest deemed by virtue of subsection 2 above to be paid or received by any company shall be deemed to be interest under a loan relationship, and be the debits and credits falling to be brought into account for the purposes of that chapter, so far as they relate to the deemed interest, shall be those given by the use in relation to the deemed interest of an authorised accruals basis of accounting. And if I could just interpolate there, an accruals basis of accounting, we at the bar for years were taxed on a cash basis, and of course even we now have to actually deal with an accruals basis of accounting. But what an accruals basis of accounting does is it's not concerned with the time of payment, it's not concerned with receipt or receivability, it's concerned with the passage of time. It's concerned with entitlement and the passage of time.
So you spread the income across the period to which it is said to relate.
To which it relates, my Lord, yes.
So you can work out if by reference to a given proportion of the period, how much of the overall interest payment is attributable to that portion.
That's absolutely right, my Lord, yeah. And in this particular case, I mean, you'll see it when we come on to dealing with the gilts, but I mean, DCC held the gilts on the example we've given for 18.5 days out of the 182.5 days of the coupon period.
One has to do it in a case like this because there isn't, in commercial terms, there isn't in legal terms any interest.
Well, that's right, yes. And that explains the deeming. And we'll see, it's exactly the same structural approach that is adopted in 737A. But so far we've got
But subsection 6 was, of course, as is obvious, introduced by amendment by the Finance Act 1996. So it's looking forward to the next bit you're coming to.
Yes, my lord, that's absolutely right. I mean, this particular provision, 730A, was in force in 1995, so it had actually some operation for a short while before the loan relationships provisions. In those circumstances, it simply brought forward a charge of interest under Section 18 for both companies and individuals if they're involved. But from 1996, it's deemed to be a loan relationship, and the 1996 provisions apply. And then I don't think I need show your lordship 6A, 7, 8, but 9. In this section, references to the repurchase price are to be construed in cases where Section 37A applies, and in cases where Section 737A would apply if it were in force in relation to the securities in question, as references to the repurchase price which is, or as the case may be, would be applicable by virtue of Section 737C 3B9 or 11C. And I'll show you, your lordships, that in a moment, but that's the one that brings in the amount of the coupon. It's 9.
Sorry, could you just point to where that is again? I was looking at something else.
It's subsection 9, my lord.
Oh yes, I beg your pardon.
In
Yes,
this section, and it's the whole of subsection 9, but in particular it brings in the reference to Section 737C, 3B9 or 11C.
Yeah. So is it A or B here?
It's A, my lord. There is a difference between 730A and 737A in this sense that 730A can apply to situations where no income arises in the repo period. 737A can only apply to circumstances where income arises in the repo period.
I'm being very thick about this. I'm not sure I understand subsection 9 at all.
It's simply increasing, my lord, the repurchase price in subsection 2 by reference to, in particular, the terms of section 737C9. Could perhaps we just look at that immediately, and I think that might answer your lordship's query.
Which of these are we looking at? Is it 3B, 9 or 11C?
What we're looking at, it's 9, my lord.
But does this have any relevance beyond showing that the case falls within subsection 2A?
My lord, at the end of the day, no. What it shows is that 730A gets to the same result as the accounting result because you've got to add in the amount of the coupon.
Do we go to 737A subsection 9? Do we?
737C, my lord, subsections 8 and 9.
I think, just going back to saying, the answer to Lord Collins' question about whether it's subsection 9A or B may be answered by the very complicated provisions as to how section 737A came into force, which we see in a note on page 1706 of this print, that it was enacted by the Finance Act 1994. It came into force in relation to some payments after 1 May 95, but others for 6 November 96. That probably just explains the reference to if it were in force.
Yes, my lord, yes, I'm sorry. Yes, you're absolutely right. I'm sorry, yes.
It's
two
a
provisions-
minor detail, I think.
One of the provisions was enacted by the Finance Act 1994, the other by the Finance Act 1995. And my Lord Walker is absolutely right that the reference in subsection 9 is a reference to section 737C if it were in force, or its operation as if it were in force, because it only came into operation after 730A itself. And well, one needs to understand most of 737A really before getting to the point about the adding in of the coupon, but the particular provisions, if one looks at 737C 8 and 9, 8 says where this subsection applies, the amount which by virtue of section 737A5 is taken to be the gross amount of the deemed manufactured payment for the purpose of paragraph 3 of Schedule 23A shall be taken to be the gross amount of the deemed manufactured interest for the purpose of this section.
I'm sorry, I hesitate to go back to 73A, subsection 9. But we are just going to 737C3B and subsection 9, are we? And not 11C?
We could look at all three of them, my Lord, and perhaps it would be helpful. 737.
But which ones are relevant?
Well, it's 9 is the one that does
yes.
it. Subsection 9 of 737.
And you have to read 8 as well.
My Lord, yes, to get to 9, that's right. What 8 does is consonant with 737A. It looks at the coupon. And it treats the coupon as if it were a payment of manufactured interest. And it adds that amount, if you look at 9, where subsection 8 above applies. So you see 8A and B, and then where subsection 8 above applies, the repurchase price of the securities shall be treated for the purpose of section 730A as increased by the gross amount of the deemed manufactured interest.
That's the 28 point.
Sorry,
That's the 28.8.
that's the 28.8, yes.
And so now we know that the case comes within subsection 2A of section 730A.
Well, yes.
Is that right?
That's
But that's the sole purpose of looking at these other
Yes,
provisions.
it's to get to the result of 730A. And it's helpful in understanding the purpose of 730A, because on the ordinary transaction, the income would be received by somebody else. What they're actually doing in these provisions is to make sure that anybody who's got a capital sum or capital profit is treated as if he got an income or interest profit. And that's the consonant philosophy of the provisions. So if I just return to complete 730A very briefly, subsection 8 gives certain exceptions to the operation, but none of them are relevant here. And there's an interpretive provision in 730B, which might be referable to the facts, but we're all agreed that the facts satisfy 730A.
So do we get anything out of 730B?
Not, my Lord, of any real material purport as far as the case is concerned. But if I could then go to 737A itself. So I've dealt with 730A, and I'm not going to say anything more about the construction of that, save only that that gives you the result that equates to the economic profit in the accounts. And that, as we say, has exhausted that purpose. The purpose of the other provisions must therefore be to do something more than that particular purpose, because that purpose has already been achieved. And again, consonant with the point I made, again, all these provisions under the heading tax avoidance about 730A, one can see when one looks at the terms of 737A that its purpose is to create streams of income to a taxpayer that in law would not otherwise exist.
Though they would, if you're looking at the commercial substance of the thing.
My Lord, not in this case, no. In answer to your Lordship, I said as far as 730A is concerned, yes, I'd agree with that. Because 730A gives one the result that does equate to the economic consequences of the transaction. 737A doesn't. 737A invents income flows, which in its wisdom Parliament has invented, but they do not, in my respectful submission, equate to the commercial results of the transaction at all. And indeed they can't, because 730A has already taxed those commercial results. What they do is they go out of their way to create income flows for the benefit of the revenue to tax them. And unfortunately for the revenue in this particular case, the vice of this case is exactly the same as in the Bank of Ireland case. The vice of this case is that we've got a taxpayer onshore that gets a deduction in the 737A, and the corresponding income referable to that deduction is earned by a taxpayer abroad who is not subject to the UK tax legislation. So as we see, when we look at 737A and section 97, it creates a debit for DCC of 28.8 million and creates a corresponding credit for X-Bank of 28.8 million. And if X-Bank were resident in the UK, it would be paying tax on the amount of that coupon. And there's been an enormous amount of confusion caused in this case by trying to say, and this it seems to me is the basis of Lord Justice Moses' judgment, of saying that the correlation between the debit to DCC is not that credit to X-Bank, but is somehow the taxation of DCC on its limited ownership of the gilts.
That's 737A5, is it? Or?
Well, Lord, yeah, yes. So could I just briefly go through 737A itself, and then we need to look at the dividend manufacturing regulations, fortunately only briefly. But 737A and Section 97 are the key provisions of this case. I said there's no dispute about 730A. It's these provisions that give rise to the debit, and we say they do not give rise to any corresponding credit that could be brought in against DCC. We say, of course, that they do bring in a credit as regards X-Bank, but that can't be taxed because it's abroad. So 737A, this section applies where on or after the appointed day, a person, the transferor, agrees to sell any securities, and under the same or any related agreement, the transferor or another person connected with him is required to buy back the securities, and then the B doesn't apply. So that's our situation. And then two, we satisfy these conditions.
Just 1 second.
Is the other person connected?
My Lord, here, we don't have, no, we're not concerned with a person connected at all. We're simply a situation whereby X-Bank has sold to DCC and DCC has agreed to sell back to X-Bank.
Well, I mean, so does subsection 1 apply?
Yes.
How does that come about?
Because it says the transferor, that's
it's simply the
X-Bank,
transferor. Yes, I see.
X-Bank agrees to sell any securities, and under the same or any related agreement,
Yes.
so it's a related agreement, the transferor is required to buy back the securities.
Yes, that's the bank.
That's right, yes, yes. I mean, this provision was the provision in the Bank of Ireland case, and the reference to another person connected with him is actually relevant to that case, but we'll come to that later. So that's the basis on which 737A1 applies. And then two, the conditions are, A, As a result of the transaction, a dividend which becomes payable in respect of the securities is receivable otherwise than by the transferor. And that's the main difference between 730A and 737A. So this is actually looking at income on the securities in the repo period becoming payable to somebody other than the transferor. In this case, becoming payable to DCC.
So the coupon counts as a dividend, is it?
Yeah, it's defined, when we look at the schedule, my lord, dividend is defined to include interest when you're concerned with securities.
And here it's receivable by DCC, is it?
That's right, my lord, yes.
Who is somebody otherwise than the transferor?
Yes. So as I said, DCC buys the securities relatively shortly before the coupon payment date, buys them for 812 million, takes the coupon of 28.8 million, sells them back for 785 million. So that's the condition in 2A. And then 2C, there is no requirement under any agreement mentioned in subsection 1 above for a person to pay to the transferor on or before the relevant date an amount representative of the dividend. And if I just pause there to explain that, sometimes in these repo transactions, you will have a situation whereby there is a sale by a transferor to a purchaser, and the purchaser will agree that if he receives a dividend or interest, he will actually pay an amount equal to that back to the transferor.
Is that what's called a gross pay?
My lord, yeah. In my own friend's terminology, and I'm quite happy to accept that as well, that's what's called a gross pay repo. And in those circumstances, that is a payment of income. And what these provisions are doing is saying that if you're in a net paying repo situation, where you don't have that obligation to pay it over, you are deemed to have made such a payment, to make a payment of income. And it goes back to this point that the whole purpose of these provisions is to create artificial streams of income for the purpose of taxing them. And to create them from transactions that, as a matter of ordinary legal analysis, don't give rise to a payment of income.
And this is subsection 5, is it?
My lord, yeah, okay, right, yes, my lord, yes.
But so far as subsection 2 is concerned, there's no dispute that these conditions are satisfied.
No, my lord, that's agreed. And I mean, subsection 2D, just to finish it, it is reasonable to assume that arriving at the repurchase price of the securities, account was taken of the fact that the dividend is receivable otherwise than by the transferor. That's all agreed. So if I just look briefly at 3 and 4, then Lord Clark says subsection 5 is the best one. But 3, for the purpose of subsection 2, about the relevant date is the date when the repurchase price of the securities becomes due. And it's a small point, but it's actually important to notice that, of course, may well not be the same date as which the coupon is paid. Most likely not going to be the same date. So there is here a deemed loan separate from the gilts, as we would say here when we look at provisions of section 97, but it's got a deemed date of payment of this income, and that is when the repurchase price of the securities becomes due. And then 4, where does a person connected with the transferor? It doesn't matter, it doesn't apply to us. Then 5, where this section applies, Schedule 23A and dividend manufacturing regulations shall apply, as if the relevant person were required under the arrangements for the transfer of the securities to pay to the transferor an amount representative of the dividend mentioned in subsection 2A above. A payment were made by that person to the transferor in discharge of that requirement, and C, the payment were made on the date when the repurchase price of the securities becomes due. So just to pause there again as a matter of terminology, that's only a fiction for the purpose of Schedule 23A, as far as that particular provision is concerned. So Schedule 23A and dividend manufacturing regulations shall apply. We'll see how that fiction is developed further by Section 97, but As a matter of language, that is simply a fiction for the purposes of Schedule 23A and the dividend manufacturing regulations. And what Schedule 23A is concerned with mainly is withholding tax. It's mainly concerned with putting obligations on people who are deemed to be making these payments to account for tax in respect of them. And you'll see there's a definition in 6 of the relevant person. So it means A, where subsection 1A above applies, the person from whom the transferor is required to buy back the securities, and the other way around, etc. The 737B is the interpretation, and I think...
Should we just glance back a page to see section 736A introduces Schedule 23A?
Yes, my lord, yes.
And uses for the first time, I think, the phrase, an amount representative of a dividend.
Well, I was just going to go to that just before going to Schedule 23A, but you're absolutely right that this is the provision that introduces the schedule. So to have effect in relation to certain cases where under a contract or other arrangements for the transfer of shares or other securities, a person is required to pay to the other party an amount representative of a dividend or payment of interest on securities. So by 737C, 737A and C, we've got an obligation, a deemed obligation under the statute, to pay an amount representative of the interest. In consequence of that, by 736A, we're then obliged to look at Schedule 23A. And that is over the next tab, at tab 3. And the particular paragraph that actually applies to us is 3, but I'd better just look at the interpretation. So, paragraph 1 of the schedule, interpretation, one sees the reference to manufactured dividend, the fourth definition down, manufactured interest and manufactured overseas dividend shall be construed respectively in accordance with paragraphs 2, 3 and 4 below. Show references to the gross amount thereof. Paragraph 2 is concerned with manufactured dividends on UK equities, and 2A it deals with the deductibility of manufactured payment in the case of the manufacturer. So those provisions are looking at shares, dividends on UK equities. And then 3 is looking at manufactured interest on UK securities in general.
So that's the one we need to look at.
That's the right one, or yes. And 3.1, this paragraph applies, subject to paragraph 3A below. In any case where under a contract or other arrangement for the transfer of UK securities, one of the parties, an interest manufacturer, is required to pay to the other, the recipient, an amount of the manufactured interest which is representative of a periodical payment of interest on the securities.
Now, could you translate that into our parties here?
My lord, yes. Under 737A, DCC is required to make a payment, a periodical payment of interest on the securities. That's the manufactured interest. And 2A, for the relevant purposes of the Tax Act...
So the... Who's who then? The interest manufacturer is who?
Is DCC, my lord. Because it's deemed to be making that payment, which it didn't make, by 737A and C.
And the recipient is the...
And it's deemed to be making it, as far as these provisions are concerned, to the other party, I expect. But there's a slight quirk on that when we come to subsequent legislation. So DCC is deemed to be making that payment, and then 2 says, for the relevant purpose of the Tax Act and their application in relation to the interest manufacturer, A, the manufactured interest shall be treated, except in determining whether it is deductible, as if it were an annual payment to the recipient, but where neither yearly interest nor an amount payable wholly out of profits or gains brought into charge for income tax. I'll just pause there. The only purpose of making it an annual payment is that anybody making an annual payment is obliged to deduct tax at the withholding tax rate. That's the only purpose of that. But B, the gross amount of that deemed annual payment shall be taken, one, to be equal to the gross amount of the interest of which the manufactured interest is representative, and two, to constitute income of the recipient falling within section 1A.
So that's income of the bank.
That's right, my lord. So the bank would be assessable on that. The reference to section 1A is simply a reference to the rate of tax that would be applicable on that. And then C, an amount equal to so much of the gross amount of the manufactured interest as is not otherwise deductible shall be allowable as a deduction against the total income, or as the case may be, total profits of the interest manufacturer.
So that creates a debit.
Well, Lord, yes. So looking at the purpose of these provisions, they are seeking to create a charge on the recipient of the deemed manufactured payment, that's the bank, and a debit for the person making the deemed manufactured payment. And then 3 says, for the relevant purposes of the Tax Acts in their application in relation to the recipient and any person claiming title through or under him, the manufactured interest shall be treated as if it were a periodical payment of interest on the securities in question, and B, the gross amount of that deemed periodical payment of interest shall be taken to be equal to the gross amount of the interest of which the manufactured interest is representative. Now, as we can see, if we look at paragraph 11 here, if one's concerned with UK gilts, there isn't an obligation to withhold tax. That's an exception under the tax code, no doubt for the benefit of the government or whatever, but if you've got UK gilts, there isn't an obligation to withhold tax. But these provisions would apply, for example, to repos of shares, would apply to repos of loan stocks of companies. And the point one's making here, and it's accepted by Lord Justice Moses in his judgment, I could go on to demonstrate it further by reference to these, but what all these provisions tell one is that one starts with the gross amount of the interest. It's always the gross amount of the interest. That's deemed to be the manufactured payment. Even if you have to withhold tax from it, you have to withhold tax and calculate that tax by reference to the gross amount of the interest, not some other amount. So here, if we were concerned with a loan stock, not gilts, and there was a deemed payment of 28.8 million, the payer would have to account to the revenue for tax at the appropriate rate on 28.8 million, not any other sum.
Could I just make sure I've understood that? We're dealing here with 5 transactions in gilts.
My lord, yes.
And all of them pay interest half yearly under deduction of tax. Is that right?
No,
No.
the gilts don't have any deduction of tax, my lord.
Right.
They're gross payments. And there isn't any obligation here under this schedule, in consequence of that, to withhold a deduction of tax on that payment. But if you were concerned with a loan stock, or you were concerned with another payment that wasn't gilts, then you would have an obligation to compute tax by reference to the gross amount of that payment.
And they are entirely free of UK tax in the hands of a foreign holder.
My lord, absolutely, yes. I mean, that in a sense is the problem of the revenue here. I mean, perhaps, could I just show your lordship paragraph 3A, and I probably should have done this earlier. 3A1, where any manufactured interest is representative interest on securities to which this paragraph applies.
I'm sorry.
3 capital A, my lord, yes, sorry.
Sorry, which section are we dealing
Yes.
with?
Paragraph 3A, just on the right-hand side of this
Yes,
page,
yes.
1988,
3A, yes.
yeah? where any manufactured interest is representative interest on securities to which this paragraph applies, A, paragraph 3.2 above shall not require any deduction of tax to be made on the payment of that manufactured interest. Without prejudice to any other liability is to income tax in respect of the manufactured interest, the recipient shall not, by virtue of paragraph 3.5, be liable to account for any income tax in respect of that manufactured interest. This paragraph applies to A, gilt-edged securities.
Yes, yes, thank you.
So that's the point. So I'm just making the point here that when one's concerned with section 737A and its application of Schedule 23A, it is plain from these withholding tax obligations that they're always talking about the gross amount of the interest. They never talk about any other amount, any less amount. So that if one had interest on a loan stock here and a manufactured payment made in respect of it, and let's assume that that manufactured payment was the amount of interest, which was 28.8 million, the person deemed to be making that payment would have to withhold or account at least to the revenue for tax on that 28.8 million, not some lesser sum. So the only point I'm making there is that the whole scheme of this legislation, based on 737A, is looking at income taxable in the hands of the deemed recipient and deductible in the hands of the deemed payer of a gross amount equal to 28.8 million and no other. And one can see that if one just looks at subparagraph 13 of paragraph 3, having dealt with the withholding tax obligations, it then says, for the purpose of this paragraph, reference to the gross amount of any interest or payments are references to the amount of the interest or payment before the making of any deduction of income tax that is required to be deducted from it while it's being paid. So just pausing there, 737A is dealing with two types of what it terms manufactured interest. There is, in the gross paying repo situation, a real contractual payment made by somebody in the position of DCC to X-Bank. So there is actual payment of an amount equal to 28.8 million or whatever the coupon would be in those circumstances. But 737A also goes on to say that if you're in a net paying repo situation and you haven't made that contractual payment, you are deemed to have made it. And the consequence of that is to create deemed fictional income for X-Bank and a deemed fictional payment of interest by DCC. And it's that deemed fictional payment of interest which, as we shall go on to see, by force of Section 97 of the Finance Act 1996, is the debit of £28.8 million in this case, that every judge so far, excluding the Special Commissioner, has actually found to be the correct analysis of 737A and Section 97 of the Finance Act 1996. It's this deemed notional payment of manufactured interest by force of 737A that then comes into, as we shall see in a moment, Section 97. I mean, could I then go to the loan relationships provisions and deal with them in their entirety? I mean, on the point I've just been dealing with, it's Section 97 that is key, and then we come back to Section 84. But I think I should actually try logically to go through them all that are relevant to this case. As we've included the whole of Chapter 2. We've included the relevant parts of Schedule 9. There are, I think, 5 or 6 other schedules that are relevant to loan relationships. It's a bulky sector of our legislation. We haven't included those because they're not directly relevant to the case, but it does demonstrate that the way in which This law is different to the pre-1996 law, whereas we see in the charging provisions is just interest of money. We've now got a few hundred, 500 odd pages of fiscal legislation dealing with loan relationships of companies. Section 80, this is just behind tab 4, for the purpose of taxation of loan relationships, for the purposes of corporation tax, all profits and gains arising to a company from its loan relationships shall be chargeable to tax as income in accordance with this chapter. So it doesn't matter whether it's a capital gain or whatever, everything is to be deemed to be income. 2, to the extent that a company is a party to a loan relationship for the purposes of a trade carried on by the company, profits and gains arising from the relationship shall be brought into account in computing the profits of the trade. 3, profits and gains arising from a loan relationship of a company that are not brought into account under subsection 2 above shall be brought into account as profits and gains chargeable tax under case 3 of Schedule D. If I just pause there for a moment, it's of some significance when we come to look at section 84 as to these words that my learned friends rely on so much about fairly representing and taking together, to notice that at the end of the day, in charging, you've actually got to distinguish between your loan relationships carried on for a trade and your loan relationships carried on for other purposes. So, for example, if you'd actually incurred some expenditure which was relevant to a trading loan relationship and a non-trading loan relationship, you would actually have to apportion fairly that expenditure between those two relationships. And that is one of the factors that we rely on as the significance of the word fairly in section 84. I mean, there are a whole lot of others, but what one can just see here on the structure of the legislation, that there's nothing else that helps you on that. You've just actually got to fairly apportion or attribute that expenditure between two loan relationships which are treated differently.
So DCC is not carrying on the trade.
No, DCC is just investable.
But if the bank were covered, it would be.
Yes, and the bank might, in certain circumstances, have a loan relationship which wasn't part of its banking trade. It's difficult in the case of a bank to think of that, but obviously other taxpayers could be carrying on a trade and carrying on an investment business, incurring expenditure for the purposes of both loan relationships. You've then got to apportion that expenditure between the two. What we say is fairly represents is a reference including that kind of apportionment.
The reason why the bank isn't within these charging provisions is not simply because it's abroad, is it because it receives the money abroad as well?
No, it is because it's abroad, my lord. I mean, there was a sea change in our legislation, I can't remember exactly, about 15 years ago, when there were various withholding provisions applicable to securities. It was when Nigel Lawson was Chancellor of the Exchequer. And there were various withholding provisions applicable to securities paid abroad. Because the country at the time wanted to actually get more foreign investors investing in the UK, they got rid of all those withholding tax provisions. So therefore, if you are a foreign investor investing in the UK, not through a trading branch in the UK, and receiving income on securities, gilts or whatever, there isn't any withholding tax, and therefore you have no liability. So nowadays, the only reason for them not being liable is their non-residence.
So this is only relevant, therefore, it's only section 81 and 3, is it relevant here?
Yeah, yes, section 80, subsection 3 is the one that applies to DCC, my lord, yes. And just briefly, 4, this chapter shall also have effect for the purposes of corporation tax, for determining how any deficit on a company's loan relationships is to be brought into account in any case, including a case where none of the company's loan relationships fails by virtue of this chapter to be regarded as a source of income.
Falls.
My lord?
You said fails, I think.
It is false.
Yes, I'm sorry, yes. My lord, I'm trying to read it too quickly. There's not much terms on that, but it just brings out the point I made earlier, that a loan relationship is the source of income for the purposes of these provisions. That's why section 80, subsection 4, uses that terminology to, as it were, give you a deemed loan relationship in circumstances where you've simply made a loss and you haven't actually got a loan relationship as such. And then subsection 80, subsection 5, says, subject to any express provision to the contrary, The amounts which in the case of any company are brought into account in accordance with this chapter, as respects any matter, shall be the only amounts brought into account for the purpose of corporation tax as respects that matter. So it's saying this is an exclusive code for the taxation of loan relationships. You can't tax them under anything else. And then section 81, meaning of loan relationship. 81.1, subject to the following provisions of this section, a company has a loan relationship for the purpose of the Corporation Tax Acts, wherever A, the company stands, whether by reference to a security or otherwise, in the position of a creditor or debtor, as respects any money debt, and B, that debt is one arising from a transaction for the lending of money. Now that, my lords, is the general definition. That general definition brings in the case of DCC, its ownership of the gilts for the 18.5 days. Because as a matter of law, the company, DCC, stands for those 18.5 days in the position of creditor of the government by holding the gilts for 18.5 days as regards a money debt. So that's the general charging provision. And in this case, by force of the statute, we have three loan relationships. The one that is brought in by section 81, as far as DCC is concerned, is its ownership of the gilts for 18.5 days. It stands as a creditor of the government for those days. That, as a matter of legal analysis, is its position in law, and as a matter of legal analysis in construing the terminology here as to that application. And there is no dispute between my learned friend and myself that that is the application of section 81.1 as far as the gilts are concerned. So there is a position whereby for those 18.5 days, DCC is in the position of creditor under a loan relationship. And then we shall have to see, under the computational provisions, what DCC has to bring into account in respect of that creditor-loan relationship. In this case, there are two other loan relationships, and they're both statutory fictions. So they don't fall within section 81.1, absent their statutory fictions. And the first is that section 730A, which we've looked at, and the second is section 737A, together with section 97 of the Finance Act 1996, which deems that situation to constitute a loan relationship and deems interest to be paid under it. So it's 81.1, the general provision, that brings in that relationship on the gilts. And your lordships would appreciate, I'm sure, that that is bringing in a relationship which the accountants in the statutory accounts don't recognise.
Don't recognise.
Don't recognise, my lord, yes. If your lordships will remember, I'm sure, that the accounting treatment based on FRS 5, substance over form, says we disregard the legal form, we treat this transaction tantamount to a loan by DCC to X-Bank. As a matter of legal analysis, there is no such loan. That's how the accountants account for it. That isn't a loan that could fall within section 81.1. That's no doubt why it's picked up by section 730A and is deemed to constitute a loan with interest flowing under it.
Picked up by section
730A, my lord.
Subsection 6, which we've
My
seen,
lord, yes.
isn't it?
Yes. So it's important to bear in mind that under the loan relationships, we've got three quite separate loan relationships. The one I'm looking at the moment is the one on the gilts, which is brought in by section 81.1. That isn't accounted for in the statutory accounts at all. Because in the statutory accounts, the accounting regime, the person who is regarded throughout as still owning the gilts is X-Bank. And X-Bank, as a matter of accounting, not only continues to account for its ownership of the gilts, but also continues and must account for the interest on the gilts. A great deal of confusion was caused below when my learned friend in reply referred their lordships to a question and answer in the evidence of Mr. Holgate. And you'll see when we come to look at it, that was a question and answer by reference to the accounting treatment in the statutory accounts. It's got nothing whatsoever to do with the taxation of the gilts relationship of DCC, because in the statutory accounts, DCC is not treated as having a relationship in relation to the ownership of the gilts. I mean, the accountants just look at the transaction and say, we regard this as a short-term loan by DCC of 812 million throughout the securities, because the beneficial rights in them and the fluctuations in value will remain with X-Bank, therefore we will treat them as being owned throughout by X-Bank. There's an enormous amount of confusion, and it's particularly in the judgment of Lord Justice Ricks, one can see it has been caused by that, but it's terribly important to distinguish, in my respectful submission, the accounting treatment in the statutory accounts, which is a deemed loan by DCC, but the continued ownership of the gilts and the income on them by X-Bank, from the three loan relationships that we have to look at under the legislation. The first being this, the gilts. The accounting treatment of the statutory accounts doesn't help you on that at all, because DCC is not treated as being the owner of the gilts. And then we've got to look at the two fictional loan relationships. And as I've already said, the one under section 730A gives a result that corresponds with the accounting treatment in the statutory accounts.
Corresponds to?
The one under section 730A, my lord, gives a result which corresponds to the result in the statutory accounts. And if I could just notice fairly briefly, 82 and 83, they're not at the heart of the matter, but I think perhaps they're just... Section 82, method of bringing amounts into tax. One, for the purpose of corporation tax, the profits and gains arising from the loan relationships of a company and any deficit in the company's loan relationships shall be computed in accordance with this section using the credits and debits given for the accounting period in question by the following provisions of this chapter. And then two, to the extent that in any accounting period a loan relationship of a company is one to which it is a party for the purpose of a trade carried on, then it's treated as receipts of a trade and expenses of the trade. That doesn't apply here. Three, whenever in any accounting period there are in respect to the loan relationship of the company both credits that are not brought into account under subsection 2 above, non-trading credits, and B, debits that are not so brought into account, non-trading debits, the aggregate of the non-trading debits shall be subtracted from the aggregate of the non-trading credits to give the amount to be brought into account under subsection 4 below. And then 4, that amount is the amount which for any accounting period is to be taken, according to whether the aggregate of the non-trading credits or the aggregate of the non-trading debits is the greater, to be either A, the amount of the company's profits and gains for that period, that are chargeable under Case 3 of Schedule D as profits and gains arising from the company's loan relationships, or B, the amount of the company's non-trading deficit for that period on its loan relationships. And 5, where for any accounting period a company has non-trading credits but no non-trading debits in respect of its loan relationships, the aggregate amount of the credit shall be the amount of the company's profits and gains for the period that are chargeable under Case 3 as profits and gains arising from those relationships. 6, where for any accounting period a company has non-trading debits but no non-trading credits in respect of its loan relationships, that company shall have a non-trading deficit. And 7, subsection 2 above, as far as it provides for any amount to be deductible as mentioned in paragraph B of that subsection, shall have effect notwithstanding anything in section 74, allowable deductions. So it's simply, as it were, passing the various debits and credits as a matter of computation into charge as trade or non-trade, an allowance trade or non-trade. That's all that's doing. So for our purposes, it doesn't add a great deal. 83 is simply concerned with the non-trading deficit on loan relationships, and that's therefore looking at a situation where you've got an excess of debits there and what you can do with it. But then section 84 is a matter much relied on in this case, and it is the basic computational provision in this case. Section 84, debits and credits brought into account. The credits and debits to be brought into account in the case of any company, so we're looking at DCC, in respect of its loan relationships. So as I already said, it's got 3 loan relationships for the purposes of section 84. The first, its ownership of the gilts. The second, the one under 730A. And the third, under 737A. So those are the loan relationships that are identified for the purposes of this provision. Then the next words, shall be the sums which, in accordance with an authorised accounting method and when taken together, fairly represent for the accounting period in question, then if we jump to B, all interest under the company's loan relationships and all charges and expenses. Now, just to get some things out of the way, we're not here concerned with charges and expenses. We're not actually here concerned with profits, gains and losses of the company. For this reason, that under the 2 fictional loan relationships, all we're told is that there is a loan relationship and interest arises under them. There's not deemed to be a profit or a gain or a loss, only interest. Under the gilts, there's a provision which I'll show you in a moment. It's paragraph 15 of Schedule 9. But that says that you can't have a profit or gain on the acquisition and disposal of the gilts in the case of DCC. So effectively, as far as DCC and the gilts is concerned, we're simply left with having to look at what interest can be brought into account in respect of DCC's loan relationship represented by the gilts. Now, I agree we've got to look at all the words of subsection 1, but just in application to our case, we're actually only concerned with all interest. So, what we say, and I may have to come back to this when looking at the judgments below, but shall be the sums which, in accordance with an authorised accounting method and when taken together, fairly represent for the accounting period in question. The critical first question is all interest under the company's gilts loan relationship. And the revenue, and Lord Justice Moses and Lord Justice Ricks say the answer to satisfying that requirement is to bring into account £28.8 million, being the coupon on the gilts for a 6-month period, despite the fact that that manifestly flies in the face of the requirements of the provision, which says that the sums that have been brought into account in respect of the interest on DCC's loan relationship must be in accordance with an authorised accounting method. And we can see this from the other provisions, but as I said earlier, the accountants are never interested in the moment of payment or whether you've got the cash or whatever. What they're actually concerned with, an authorised accruals basis, and we'll see it in the statute and we'll see it in the evidence, what they're concerned with is the period of time that you hold something in respect of which something accrues, and they will accrue that something over the period of time that you hold it. And this point is terribly important because in our respectable submission, the only way in which those words, in accordance with an authorised accounting method, and indeed when taken together, fairly represent the interest, looking at the gilt's interest, you can only get to an answer which represents the interest accruer of 18.5 days of interest and not 182.5 days of interest. And that figure is £2.9 million. And that's terribly important. Again, we'll come to look at what Lord Justice Moses has decided in this case in particular. One's got to realise, let's assume X bank is resident in the UK. X bank is therefore liable to tax in respect of the gilts. And let's assume, to make it simpler, it could have been lots of other people, but let's assume that X bank owned the gilts throughout the 6-month period. But on any basis, let's assume that whoever owned the gilts within that 6-month period was a UK resident. They, in consequence of section 84(1), will have to account for the accruer of interest during their period of ownership. So assuming it's X bank, you end up, I think, with 164 days of interest, £25.9 million, which would be the accruer in the case of X bank. And yet the result for which the revenue seek to get to in this case, and which Lord Justice Moses and Lord Justice Ricks, in their different ways, have agreed with, gives rise to this result, that in respect of a 6-month accrual of interest on these gilts, which gives rise to a total amount paid by the government of 28.8 million, there is to be taxed in respect of that relationship, there is to be taxed on DCC 28.8 million, and to be taxed on X Bank 25.9 million.
Not quite sure where the 25.9 comes from.
It's the difference, my lord, between 2.9 and 28.8.
Oh, I see, yes.
It's the 164 days.
My lord, that's right,
Yes,
yeah.
I see.
It's the 164 days.
Yes, right.
It's the accruals basis. I mean, I've probably been around too long at the tax bar, and I remember when everything was dealt with on a receipts basis. We've just got to forget about receipts.
Yes.
I mean, accruals is the basis of this taxation. And that is related to days. And therefore, looking at the ownership of the gilts, there's 164 days of ownership and 18.5 days of ownership. Applying an accruals basis, that taxes the whole of the interest on those gilts for the whole of that period. What the two judges of the Court of Appeal have done here, and what the Revenue invite your lordships to do, is to add on to that for the same period another 25.9 million to be taxed. But the reason why it's not taxed is because X Bank isn't resident. if X Bank were resident, there cannot be a shadow of a doubt that it would have a liability on an accruals basis of accounting to tax at 25.9 million. And this is an extremely important point, because the whole basis, of Lord Justice Moses' judgment, as I see it, is in those last 5 paragraphs. I'd say it's an almost impeccable judgment up to paragraph, I think, 68 or 69. But what he does in those last 5 paragraphs is say, well, the debit under Section 97 has to correspond with the full amount of the coupon. Therefore, we will displace the accruals basis that gives rise to 2.9 under Section 84 with 28.8 million. But that, with respect, means that he's actually overlooking the fact that we are looking at an accruals basis, and within the charge to tax, the whole of that 28.8 million is charged to tax, albeit that only 2.9 is charged on DCC, and the remainder, the 25.9, will be chargeable on the other party. And that is the
accepted by the revenue? Is that accepted by the revenue on the hypothesis that they were resident here?
My Lord, I think it has to be, because they certainly don't deny it in their case. But I mean, my learned friend may get up and say otherwise.
He seems to be shaking his head, but anyway, we'll see.
but I mean, there isn't any. That's a point we make. We make it, I'm afraid, twice in our case. There is no response to it in Maloney Fred's written case. And I mean, my respect was, I mean, there can't be any doubt about it. I mean, I shall listen to what he has to say, but there can't be any doubt about it. I mean, accruals basis of accounting, one's never concerned with receipt, who gets the payment or whatever. You're always concerned with the accrual. I mean, that's fair enough if you think about it. If somebody buys a security, doesn't receive any interest, but he'll start accruing the interest, and when he sells it, he will sell cum div if he hasn't received any interest income, and his accounts will actually then represent that accrual, and if he makes a profit or gain over and above that, then he's made a small extra profit or gain. But I mean, he will always account for it. I mean, any taxpayer, for example, holding a security that he's bought in November, and he's got, say, an accounting date in March, in his profit and loss account, let's say we've got a coupon payment in March and an accounting date at the end of December. So he's bought a security at the beginning of November. As at the end of December, he will have accrued the interest on that security, albeit he's not received any of it, that represents 2 months of interest on that security in his profit and loss account. If he doesn't do that, he's in breach of his obligations to apply GAAP, and he won't get an appropriate, clear audit opinion from his auditors, and he will in any event have to pay tax on that accrual of interest. And even barristers have to pay tax on the supposed accrual of their fees, whether or not they receive them. One's conscious of that all the time. But that is the importance of the accruals basis. And I mean, we make 2 major points about Lord Justice Moses' judgment, and this is the second of them. But in a sense, when he's looking at the interest that it represents, he's overlooked a point that he's made earlier in his judgment, whereby he's accepted the fact that X Bank will have been accruing this interest throughout the remainder of the period. We've given lots of examples down below as to what the words fairly represent for the accounting period in question could apply to. And I don't, at this stage, because I'm trying to just deal with the legislation, go into all of those, but could I just make this point that they are not left without effect on our construction of the provisions. I've made a point already about the apportionment, the attribution between trading loans and non-trading loans. There are a whole lot of other provisions to which they can apply.
Before you move on, can I just check one point? We saw, I think in 730A, subsection 6, a reference to an authorised
Yeah.
accruals basis of accounting. So it's very specific there as to what the basis is. Those words appear again, or some of them in 84, but we don't find accruals there. Is that the source of the disagreement between you and
No,
me?
Lord, it's actually, you'll find it in 85 and 86. I hadn't just got there, I'm afraid.
Right.
I think your Lordship is ahead of me, I mean, in that sense. But it's actually set out in section 85 and 86.
Oh, I see.
And
Yes.
there is an explanation
Yes,
from
you get
Mr.
to it.
Holgate
Yes, I
as to what it actually is.
Yes.
But you know, your Lordship is absolutely right. I mean, it was specifically referred to in subsection 6 of 730A. In a sense, once you've deemed it to be a loan relationship within the Finance Act 1996, that might not have actually been necessary because they've actually got their own provisions
yes.
telling you what an authorised accruals basis is.
But it was a very big change in 1996, wasn't it? I mean, you've all got used to it now, but I think the Special Commissioner in paragraph 18 of his decision that does reflect just what a major change that it was. Was there a green paper and consultation?
I can't remember. About 2 years before, there was a green paper about the taxation of loan relationships, and that was circulated. But your Lordship was right. I mean, there was consultation on it. The result of it was the Finance Act 1996.
Because when we were members of the bar, we were on the earnings basis, which was a much easier system to live with.
Well, I think your Lordship, well, if you were, you might have been on the earnings basis. I used to be on the cash basis, which was far better. But but yes, I mean, and it is a point that arises in this case that the repo provisions were actually enacted prior to this major sea change in 1996 as far as loan relationships are concerned.
And from what you say, as if the major 1996 change was already being considered.
Yes, it was already being considered, my Lord, but these things take some time in gestation. And the repo provisions were brought in 1994 and 1995. The repo provisions were brought in at a time when the old regime of law applied. I mean, it's a point we make in our case, but the regime of law, if you were an investor then, simply looked to receipt. And Mr. Justice Rowlett, I mean, in that case of Lee, makes his famous aphorism that receivability without receipt is nothing.
Well, that indeed is quoted, although not
Yes.
in inverted commas, by the Special Commissioner.
Well, absolutely right. And therefore one can imagine that when those provisions were actually introduced, they were looking at gross payments, so that you were looking at a deduction, which was deductible as and when the payment was deemed to be made, and then the income was wholly payable as and when it was deemed to be paid. And they weren't concerned with an accruals basis of taxation at all. Now, that may be the climate in which those two particular provisions, 730A and 737A, were introduced, and they had application under the old regime for a short period of time. The problem in this case is the way in which those provisions interconnect with the real change on loan relationships in respect of accruals. And it's a point that we make in our case that Mr. Justice Henderson made in the case of Darcy, that in a tax system as complicated as ours, occasionally you will get a problem where the interaction of two separate regimes simply doesn't work out properly. And that is perhaps the explanation of the problem in this case. And perhaps just because of the importance of Section 84, I better just very briefly notice the other subsections. Subsection 2, the reference to subsection 1 after the profits, gains and losses arising to a company does not include a reference to any amounts required to be transferred to the company's share premium account. It does include a reference to any profits, gains and losses which in accordance with normal accountancy practice are carried to or sustained by any other reserve maintained by the company. And then 3 is a reference to charges and expenses, which doesn't concern us. And then 4, likewise, charges and expenses incurred by companies purposes connected with entering into a loan relationship, etc., can be deductible. And then 5, of some significance, in this section, related transaction in relation to a loan relationship means any disposal or acquisition, in whole or in part, of rights or liabilities under that relationship. As I said earlier, when we look at paragraph 15 of Schedule 9, you don't, on a repo transaction, get any profits or gains from a related transaction because you're specifically told to disregard it. And then, to deal more importantly, is Section 85 and Section 86 as far as the accounting methods are concerned. Section 85, authorised accounting methods. 1. Subject to the following provisions of this chapter, the alternative accounting methods that are authorised for the purpose of this chapter are A. An accruals basis of accounting, and B. A mark-to-market basis of accounting, under which any loan relationship to which that basis is applied is brought into account in each accounting period at a fair value. We are not here concerned with mark-to-market. Mark-to-market is basically something that some banks, at least, will mark their trading positions to, but we're not concerned. We're concerned with an accruals basis of accounting. So an accounting method applied in any case shall be treated as authorised for the purpose of this chapter only if A. It conforms, subject to paragraphs B and C below, to normal accountancy practice, as followed in cases where such practice allows the use of that method. B. It contains proper provision for allocating payments under a loan relationship to accounting periods. And C. Where it is an accruals basis of accounting, it does not contain any provision other than provision comprised in authorised arrangements of bad debts that gives debits by reference to the valuation at different times of any asset representing a loan relationship. 3. In the case of accruals basis of accounting, proper provision for allocating payments under a loan relationship to accounting periods is a provision which, and this is the more significant, A. Allocates payments to the period in which they relate, without regard to the periods in which they are made or received, or which they become due and payable. And that's the fundamental point I made about accruals, and we'll see when we look at Mr. Holgate's evidence that is a recognition of what the accountants recognise as accruals basis of accounting. So it's relating the payments to the periods in which they relate, without regard to the periods in which they're made, received, or which they become due and payable. B includes provisions which, where payments relate to two or more periods, apportions them on a just and reasonable basis between the different periods. C assumes, subject to authorised arrangements of bad debt, that so far as any company in the position of a creditor is concerned, every amount payable under the relationship will be paid in full as it becomes due. D secures the making of the adjustments required in the case of the relationships by authorised arrangements of bad debt. And E provides, subject to authorised arrangements of bad debt and for writing off government investments, that where there is a release of any liability under the relationship, the appropriate amount in respect of the release is credited to the debtor in the accounting period in which the release takes place. So the most significant provision there is 3A. And that, as I said, the periods to which they relate, the accountants look at it as a matter of time. They accrue over time. So they will accrue interest as a receivable over time. They will accrue an interest obligation as a debit, as a deduction over time. And then 86, application of accounting methods. Well, this section has effect, subject to the following provisions of this chapter, for the determination of which of the alternative authorised accounting methods that are available by virtue of section 85 above is to be used as respects the loan relationships of a company. 2, different methods may be used as respect different relationships or as respects the same relationship for different accounting periods or for different parts of the same accounting period. 3, if a basis of accounting which is or equates with an authorised accounting method is used as respects any loan relationship of a company in a company's statutory accounts. So if I pause there, the Special Commissioner thought 86.3 had application in this case. With respect to him, that's wrong. You can see that from the first 2 lines. If a basis of accounting which is or equates with an authorised accounting method is used as respects any loan relationship of a company in a company's statutory accounts, the only thing recognised in the company's statutory accounts is that which I've already referred to, which isn't actually a loan relationship. I mean, it's the in substance, effectively, DCC was making an in substance loan to X Bank. And the other point is this, that if I was looking at our 3 loan relationships, because the statutory accounts don't recognise DCC as being an owner of the gilts, then there can't be anything in the statutory accounts dealing with that loan relationship. At ex hypothesis, there can't be anything in the commercial statutory accounts of a company that is bringing into account anything in respect of a deemed statutory fiction for tax purposes.
Can you just be sure that I understood that? Can you just go over that again? We've got the three relationships that we mentioned before. Second and third wouldn't be covered by this, obviously. Are you saying the first one is or is not?
Yeah. The first one, my Lord, is a situation where, as a matter of law, DCC is an owner of the gilts for 18.5 days. That is not recognised by the accountants in the statutory accounts because they recognise that throughout X-Bank will be the owner of the gilts.
Yes.
So therefore you can't find in the statutory accounts any accounting for that relationship of DCC because in the statutory accounts it doesn't exist. Yeah. So then just to continue on from 3, in the second line it says, then the method which is to be used for the purpose of this chapter as respects that relationship for the accounting period or part of a period for which that base is used in those accounts shall be A, when the base is used in those accounts as an authorised accounting method, that a method where it is not the authorised accounting method with which it equates. Then 4, for any period or part of a period for which the authorised accounting method to be used as respects the loan relationship of a company is not determined under subsection 3 above, that's us. An authorised accruals basis of accounting shall be used for the purpose of this chapter as respects the loan relationship.
So that direction applies.
That's right, my Lord, and that's important in this sense. The structure of this legislation, as we've seen so far, it's defined loan relationships. It subsequently, by other provisions, deems things to be loan relationships. Therefore, we're concerned under section 84 with looking at a number of loan relationships and the interest arising under them. And as I said, we could enumerate them. There are 3. Interest on the gilts, that's the first one. Secondly, section 730A, the deemed one by 730A and subsection 6 of that provision. And then thirdly, by section 97, which is the 737A. The latter 2 are statutory fictions. And the first is a legal analysis, but nothing referable in the accounts to it. So what the legislation is telling us is, first of all, define your loan relationships. We've got 3. Once you've defined your loan relationships, then you must apply to each of them an authorised accruals basis of accounting to determine what, in accordance with an authorised accounting method, and that is the authorised accruals accounting method, fairly represents the interest on those loan relationships for that period. So that's the structure, that one's first of all got to define the loan relationships, and then you've actually got to apply to each of them an authorised accounting method. And we say, going back to 84.1, what you do, as far as the words when taken together, is you aggregate the results of that process, and that gives you the amount that in your tax computation you've then got to.
So that's back to section 84.1, the taken together phrase.
My Lord, yes. And then you've got to separate them, if you need to, between trading and non-trading. So then just to finish on 86.4, and I should just read 86.5a. For the purpose of this section, the subsection 6 below, a basis of accounting equates with an authorised accruals basis of accounting if it purports to allocate payments under a loan relationship to accounting periods according to when they are taken to accrue. So 84, 85, 86 are important in adopting an authorised accruals basis and in the terminology in 84.1. And perhaps come back to it when I deal with the judgments below, but we say that the result that Lord Justice Moses has come to has simply not paid respect to the terminology of 84.1, because he's come to a result which cannot possibly constitute sums in accordance with an authorised accounting method representing the interest on the gilts. I mean, he's dealt with two sections of his judgment. He first of all looks at, because he accepts that there's no dispute under section 730A, he doesn't really deal with that. He then starts by looking at the interest on the gilts. Comes to a prima facie conclusion that in accordance with the accruals basis it's 2.9. And then he says, but because under section 97 you've got a debit of 28.8, that must somehow lead you to the conclusion that that will displace the 2.9 that you've actually arrived at in accordance with the accruals basis in respect of the interest on the gilts. And there's no basis in my respectful submission for that at all. I mean, for umpteen reasons. But the first is that it means that you are actually denying the operation of those words that you are required to apply. It's got to be in accordance with an authorised accounting method, and when taken together fairly represents the interest. You're denying the operation of those words. You're simply overriding them, bringing in some other criteria which is not in accordance with an authorised accounting method. It manifestly cannot be. And that's demonstrated particularly. I mean, we make 2 points about it. I mean, there are 3 that one can make about it, but yes, there are 3. I mean, the first point is the point that Lord Justice Rymer makes in his judgment, that it is depriving those words of any effect whatsoever to override them with something that is derived not from an authorised accounting basis. The second criticism we say that is that it doesn't do enough justice to the terminology of section 97. And section 97, and I'll come to this in a moment, is simply deeming there to be a payment of £28.8 million on a loan relationship, full stop. And that is the result of a process. And the whole purpose of the statute is to leave you with that result for the purpose of looking at section 84. It's to misunderstand the statutory draftsman's purpose, to go into all the ingredients whereby you get to that process. I mean, you might have started with a cart on wheels, but a statute says that you've got to treat it as an aeroplane. For the purposes of a statute dealing with aeroplanes, you've got an aeroplane, you haven't got a cart on wheels. What you've actually got for the purposes of section 84, in consequence of section 97, is simply a debit of 28.8 million on a loan relationship to which only DCC is a party. And the third point is the one which I think I've already made, that when he's trying to make this comparison of the debit, he's lost sight completely of the fact that that debit does match a credit, and it's a credit of 28.8 million, taxable on DCC and on X-Bank. And what he's doing is creating out of 28.8 million's interest a sum total of 28.8 plus 25.9. And that, as we say, is an impossibility. And that demonstrates that he's not actually applying an accruals basis of accounting and not actually undertaking the task demanded by the statute. There are a number of other provisions, Emerald, that I could refer to that would be relevant if one had to make the point that the words fairly represented taken together do actually have application. But I don't think at this stage it's worthwhile while making that point. It's accepted below that they do have application. I could give your lordships a lot of references to where they are accepted and what they are, but I won't say anything more about them at the moment, but I'd like to get to section 97 if I could.
Yes. So you go straight to 97 now?
My lord, yes. Yes. So 97.1, this section applies where A, any amount, manufactured interest, is payable by or on behalf of, or to any company, under any contract or arrangements relating to the transfer of an asset representing a loan relationship, and B, that amount is, or when paid, will fall to be treated as representative of interest under that relationship, the real interest. So, just looking at that, that's looking at the obligation to make a manufactured payment, a real contractual payment, that represents interest received by the person in the repo transaction, and he undertakes to make a payment of like amount to the original seller. That's the gross paying repo, so-called. So that's just simply looking at a contractual payment. So this section applies where? Then 2, in relation to that company, the manufactured interest shall be treated for the purposes of this chapter. So the purposes of the loan relationships regime, Finance Act 1996, and in particular Section 84, as if it were interest under a loan relationship to which the company is a party. So pausing there, whatever it was as a matter of law in its own right, for the purposes of loan relationships, that shall be treated as if it were interest under a loan relationship to which the company is a party, for the purposes of looking at these provisions, including, in particular, Section 84.
You referred to a repo, but Section 97 is much wider than just repos, isn't
Yeah,
it?
my lord, yes. I'm concerned. I was giving that as an example that it's actually got application to a repo type transaction, but yes, you're absolutely right. It is wider than that. It could be in cum div and ex div type
Yes, I mean,
transactions.
it could be
yes.
a very, very simple stock exchange transaction,
yes.
but Parliament has given it this strange title of manufactured interest.
Absolutely right, my lord, yeah. And I mean, we only actually come into this right at the very end, subsection 4. So in subsection 1, it's dealing with, as your lordship rightly makes the point, I mean, the general situation of a contractual obligation to pay something which they call manufactured interest. Then 2A is the consequence of it for each of the parties. So it's then treated as if it were interest under a loan relationship to which the company is a party. So that must mean the recipient and the payer. As a matter of grammar, one can see, in relation to that company, and you see, going back to 97.1, this section applies where any amount is payable by or on behalf of or to any company, and that amount is, or when paid, will fall to be treated as representative interest. So, payable by or to any company, and then 2 says in relation to that company, so that must be including the recipient and the payer. So here, relevantly, ex-bank and DCC. So 2A says that in relation to DCC, as if that payment were interest under a loan relationship to which the company is a party, DCC, as we shall see, is deemed to have paid the interest. So therefore we've got a loan relationship to which DCC is a party, under which it is deemed to pay £28.8 million of interest. And under 2A, ex-bank is deemed to have received a payment of 28.8 million interest. And then B, and this dichotomy is quite significant, B then says, where that company is the company to which the manufactured interest is payable, that's ex-bank, as if that relationship were the one under which the real interest is payable. If I just look at 3 and 4 and then come back to subsection 2, because it's important in this case. 3, any question whether debits or credits fall to be brought into account in the case of any company by virtue of this section are to be brought into account under section 82.2 above, or B are to be treated as non-trading debits or non-trading credits, shall be determined according to the extent, if any, to which the manufactured interest is paid for the purpose of a trade carried on by the company or is received in the course of activities forming an integral part of that trade. Leaving the latter part aside, I just draw attention to the fact in 3 that it says, are to be brought into account in the case of any company by virtue of this section. So it's therefore predicating that section 97 is bringing into accounts for the purposes of loan relationships a debit or credit by virtue of this section. And then we see subsection 4, which brings it in. It says, where section 737A5 of the Taxes Act 1988, deemed manufactured payments, has effect in relation to a transaction relating to an asset representing a loan relationship, so as for the purpose of Schedule 23A to that Act, to deem there to have been a payment representative of interest under that relationship, this section shall apply as it would have applied if such a representative payment had in fact been made. So we've got the deeming under 737A5, the fictional manufactured payment. This section, section 97, is then to apply as if such deemed fictional payment had in fact been made. That takes us back up to 97(1) and 2. And then 2 bites on it. And so therefore we've got a situation where in consequence of 737A5, DCC is deemed to have paid 28.8 million under a loan relationship to which it, DCC, is a party. That's by force of 2A, 97(2A). And by force of 97(2B, in the case of X-Bank, receiving a payment of interest of 28.8 million, that is deemed to have received that on the gilts. And there is a clear statutory purpose there in saying that as far as DCC is concerned, that is a freestanding notional deemed loan relationship. It is not the one on the gilts.
Sorry, a freestanding loan relationship.
Notional loan relationship,
Yes.
It is not the one represented by the gilts.
Not represented by the gilts.
Yes, my Lord.
And you draw attention to the contrast between 2A and 2B in that, do you?
That's my Lord, yes, that's right.
Because the real interest is the real interest on the real gilts, but that comes in under B only.
Yeah, that's absolutely right, my Lord. And of course, it'll be somebody else that is actually paying the coupon. Here on the gilts, it's the government. So therefore, the draftsman is recognising that the payment of the interest that he is deemed to arise can't be a payment in respect of the gilts loan relationship. It must be a freestanding, fictional loan relationship which the draftsman has invented. And he's invented it so as to correspond to the income which he seeks to charge, which is the income on the gilts.
Yes.
So what we say about that is that as a matter of looking at the statutory purpose, what one's actually got for the purpose of loan relationships is a deemed payment of 28.8 million by DCC on a notional borrowing by it, a notional loan relationship created by the statute, under which DCC is the only identified party, and DCC is the debtor paying the interest under that loan relationship. And in consequence of that, on an accruals basis, the whole of the 28.8 million must accrue as a debit to DCC because there is nobody else to whom that debit could accrue. And so far in this case, apart from the Special Commissioner, who with respect was on a frolic of his own, every judge has agreed with that consequence and that principle. And perhaps the best statement, the shortest statement of it is in paragraph 51 of Lord Justice Moses's judgment. But we'll come back to that and deal with it.
But it is another possible way of looking at it, and no doubt you'll come back to it, that if you were then very strongly mandated to apply an accruals basis, you say to yourself that certainly there is a notional interest payment of 28 million, but most of it is giving the bank what was really its already, and only part of it is what DCC has to contribute in order to make the book straight.
Well, look, the structure of the provision is that it may well be, as far as the bank is concerned, it may well say that on an accruals basis, I don't actually bring into account the totality of that interest. I only bring into account 25.9 or whatever, as far as the bank is concerned, because that's looking at its loan relationship represented by the gilts, and that is the purpose, I think, of making that point in section 97 2b. But per contra, the reason why 2a doesn't make it that relationship is to say the purpose of this is to give a freestanding deduction of the whole amount represented by that. That's why we only have a notional fictional loan relationship and not attaching it to anything else. And that would be the purpose of saying you are paying interest under a loan relationship, you are the only debtor under that loan relationship, therefore there must be an accruer of that full 28.8 million.
Do we get anything from Schedule 9, paragraph 15?
There are two provisions, my Lord, in Schedule 9, and I'll take paragraph 15 first of all. This was an argument that we ran before the Special Commissioner, and he rejected it, and Mr. Justice Norris rejected it, and we've accepted the consequence of that ever since. Paragraph 15, if I just briefly say what it does, it says that if you've got a repo transaction, then you in effect disregard the related transactions, the acquisitions and disposals. We originally argued, well, if you do that, then the consequence of that is that DCC should never be regarded as owning the gilts at all. Therefore, there's nothing to bring in respect of a relationship represented by the gilts. We were persuaded by the reasoning of Mr. Justice Norris that what actually this provision does is actually just to knock out any profit or gain from the purchase and disposal of the gilts, but doesn't actually knock out the fact that you were the holder of the gilts for 18.5 days. So if I can just look at the terminology then.
Yes.
So 15.1, in determining the debits and credits to be brought into account for the purpose of this chapter in respect of any loan relationship, it shall be assumed that a disposal or acquisition to which this paragraph applies is not a related transaction for the purpose of section 84 of this Act. And I read to your Lordships the definition of related transaction. It's an acquisition or disposal of the loan relationship. That's section 84, subsection 5. In this section, related transaction in relation to a loan relationship means any disposal or acquisition in whole or in part of rights or liabilities under that relationship. So if it's a repo transaction, it's deemed you don't have a related transaction for the purpose of section 84. And then 2, this paragraph applies to any such disposal or acquisition of rights or liabilities under the relationship as is made in pursuance of any repo or stock lending arrangement. It then in 3 defines a repo or stock lending arrangement in terms that would cover us. Then 4, for the purpose of subsection 3 above, rights under a loan relationship are equivalent to rights under any such relationship, they entitle the holder of any asset representing the relationship to the same rights, etc. So that's sort of notional repos. And then 5, nothing in this paragraph shall prevent any redemption or discharge of rights or liabilities under a loan relationship to which any repo or stock lending arrangement relates from being treated, as the first of this chapter, as a related transaction. And then this paragraph is without prejudice to section 730A, 2 and 6, deem payments of loan interest in the case of the sale and repurchase of securities. So the consequence of it, as we now accept, is that for the purposes of determining under section 84, any profits or losses from a loan relationship, you disregard any profits or losses that would arise from comparing the acquisition cost to the disposal. In consequence of that, we accept that there is an ownership of the gilts by DCC for 18.5 days. But what we say about that is that in pursuance of an accruals basis of accounting, the only amounts that could be brought into account in respect of that loan relationship is £2.9 million. And in accordance with an accruals basis of accounting, the only other conceivable amount that could be brought into account in respect of that relationship is 0. And that goes to Mr. Holgate's evidence, which perhaps I can show your lordships later. But what his evidence manifestly establishes is that if you're a party to that loan relationship for 18.5 days, you cannot bring in 182.5 days of interest. And that's the key point. And that's unchallenged evidence of the accounting. And we say that the problem with Lord Justice Moses' judgment in this particular case is that he arrives at a result that simply cannot stand with those opening words of section 84.
Was there another provision in this schedule that you thought we should know about?
Paragraph 13, my Lord, that's for this purpose. I mean, we haven't set out all the loan relationships provisions, but I made a point earlier on that we moved over in 1996 to this sort of highly complex, very detailed structure of the legislation compared to what we had before. Before, we were just a few charging words, interest, discounts, etc. We've now moved over to this structure of legislation which is trying to prescribe in absolute detail virtually every circumstance in which you can find a loan relationship and to which a loan relationship will apply. As I said, we've only given you one of the schedules. I mean, there are 7 or 8 other schedules as well. But now, one feature, and this is actually a feature of modern tax legislation. I mean, this is something in the last 20 years has been the way in which the parliamentary draftsman, and no doubt promoted by the revenue, has actually structured modern tax legislation. It's applicable not merely here to loan relationships, it's applicable to intangible fixed assets, it's applicable to derivative contracts, it's applicable to scientific know-how, etc., a whole raft of things. But the whole structure of the legislation is to have very, very, very detailed rules, and also to have within them a targeted anti-avoidance provision. And that's what paragraph 13 is. And if I can make this general point, the purpose, nowadays, I mean, all companies and all individual taxpayers have to self-assess themselves. If you're a company, you self-assess yourself. The purpose behind this form of statutory drafting is to prescribe very, very, very detailed rules. And it's almost like this, in a sense, that if you feed the statutory rules into the computer, and you feed your facts into the computer, the statutory rules will apply to your facts and give you an answer, almost automatically. And that is the structure of the legislation, and that's why it has, as its device for dealing with what the legislature doesn't like, tax avoidance, its own particular statutory rule. So it's got mechanical rules throughout. If But by whatever means you end up in the course of the mechanical rules, getting to a situation where, in the terminology of this provision, that the statute says, you've had an unallowable purpose to your loan relationship, then it will shoot that down. And that is of significance, in my respectful submission, one approaches the terminology here. That when we're actually looking at the loan relationship provisions, the computational provisions, in my respectful submission, they are computational, they are mechanical, they are adopting the accruals basis of accounting, and they end up with a result. The remedy that Parliament has chosen to deal with results that it doesn't like is here in paragraph 13. And that approach is exactly the same in all those other areas I just referred to. They've all got their own individual targeted anti-avoidance provision. And if I could just draw your Lordship's attention to it. 13.1 says, where in any accounting period a loan relationship of a company has an unallowable purpose, the debits which for that period fall, in the case of that company, to be brought into account for the purpose of this chapter, shall not include so much of the debits given by the authorised accounting method used as respects that relationship as on a just and reasonable apportionment is attributable to the unallowable purpose. And then if one looks at 4, 5 and 6, 4 says, for the purpose of this paragraph, where one of the purposes for which a company is a party to a loan relationship at any time, or he enters into a transaction which is a related transaction by reference to any loan relationship of the company, is a tax avoidance purpose. That purpose shall be taken to be a business or other commercial purpose of the company only where it is not the main purpose or one of the main purposes for which the company is a party to the relationship at that time, or as the case may be, for which the company enters into that transaction. And 5, the reference in subsection 4 above to a tax avoidance purpose is a reference to any purpose that consists in securing a tax advantage, whether for the company or any other purpose. And 6, in this paragraph, tax advantage has the same meaning as in Chapter 1 of Part 17 of the Tax Act, 1988, tax avoidance. We haven't got that, but I could recite it almost by heart. But it doesn't matter, because I could illustrate it very simply. It starts by talking about a relief from tax. So putting it simply, if your purpose of entering into a loan relationship, or if a main purpose of entering into a loan relationship was to secure a relief from tax, the consequent relief, the consequent debit can be shot down by paragraph 13. That's the function of paragraph 13. It hasn't been relied on in this case. There may be some reasons for that. Section 97 was amended a year after the transactions with which we are concerned with to make it plain that the deemed loan relationship created by Section 97 constituted a loan relationship for the purposes of the whole chapter. And there may have been some question as to whether all Section 97 did in our year, and the facts therefore that we're concerned with, is to simply deem the interest to be interest, rather than that there should be a loan relationship for the whole purposes of the chapter.
Can you give me or give us a reference to the amending legislation?
And could I this afternoon? I've got a note of it. Yes, I've got a note of it. Well, could I give it to you this afternoon?
Yes, it's just simply where we can find it if we'd like to look at it.
Yeah. But my point really here is that obviously in approaching the construction of these particular provisions, it is of some relevance to notice their nature. We're not talking about broad sweep provisions, disposal, losses or whatever. We are talking about very precisely targeted, detailed mechanical provisions containing their own targeted anti-avoidance provision. And it would be wrong in those circumstances, for example, in my respectful submission, to say or to suggest that the words in section 84 fairly represent, taken together, have some kind of anti-taxpayer avoidance kind of purpose. They don't. They're simply talking about the aggregation of debits and credits from various loan relationships.
Did the Court of Appeal ask Mr. Furness why paragraph 13 was not being relied on?
No, not. I mean, it never has been relied on. I mean, and the only purpose I'm drawing attention to it is that it is part of the statutory basis of this legislation, that as a matter of approach to construction, we should take account of. I mean, I've touched on it in what I've said below, but I mean, it doesn't seem to have attracted a great deal of attention in the judgments.
Well, have you finished your survey of the provisions?
Well, I think so, yes. Could I just say this, that what we've got behind tab 6, the original enactment of section 737A in the Finance Act 1994, but we've looked at the actual provision, and I don't think, yes, there's nothing else I need to look at as far as the legislation is concerned.
I think, speaking for myself at least, it's been an extremely useful survey. I wonder whether you could put in writing, for our benefit, by reference to these various sections, how they work out in relation to our particular transactions. And, for example, where we find reference made to an entity, whatever phrase is used to describe it, whether you can write in bank or DCC, as the case may be, so that we can trace them through. It would be helpful to have it in writing so that we've got some sort of framework, which, with respect, I haven't found in your written case in that form.
Well, I'd certainly undertake to do that. Could I suspect I'm not going to finish today.
Oh, no.
Could we do it overnight? Because
No,
I think we do it much better overnight rather than in the shorter term.
I'd rather you took time over it and
Yeah,
got it right in an easy to understand form.
Yeah.
Mr. Justice Norris has some of it, but not quite all.
Yes. And it's quite difficult with these provisions because, in a sense, what perhaps we've demonstrated is you actually got to get to grips with the provisions to really understand what it's all about. Could I then go back to making a few general observations, having dealt with the legislation? I mean, some of them I've already touched on, and I'll deal with them very quickly. I wanted to make three sort of preliminary points. And the first of it is really the one I've just been dealing with, and that's to say this, that, I mean, looking back, I don't think your Lordship's Court or the Lordship's House have actually seen that many tax cases over the last 5 or 6 years. The two most significant that I've seen are the decision in BMBF against Mawson, which is in 2005, which I'll take your Lordships to, on the approach towards construction and purposive construction. And that was relating to legislation extant in 1990. And the other one was William Grant, which is relating, and again I'll take your Lordships to that, that's relating to accountancy principles and stock in trade, and maybe of some assistance on the accounting. But your Lordship's Court and the Lordship's House haven't actually seen any of this modern legislation, other than the Capital Acts Act 1990. And I wanted to illustrate it, I mean, this way. I've spent all my professional life practising at the tax bar, and I dragged out of the cupboard, for the purpose of this case, my original yellow book when I was in pupillage. And this is it. But that was the totality in 1968 of our legislation on income tax, corporation tax and capital gains tax. I haven't brought them along because there's too much of them and they're too heavy, but we now have 5 volumes, each of which is 3 times the size of this volume.
Well, I remember that volume slightly bigger before I left practice, but so it's written now 5 volumes, you say?
5 volumes, my Lord, and each of them is approximately 3 times the size of that. And the overwhelming majority of that legislation has been enacted in the last 20 years. And it is, going back to this point I was making a moment ago about the loan relationships provision, the parliamentary draftsman has gone out of his way now. I mean, my dear old friend Frank Haber-Stall would never believe it. I mean, he was a man of principle, who interest of money, that's all you needed. And that was the whole of Case 3 of Schedule D. But what the parliamentary draftsman has done now, and it's the point I was making, is to prescribe these very detailed rules to govern every single aspect of life within its detailed rules, and then enshrine within those detailed rules a targeted anti-avoidance provision. I mean, how we're going to manage if we have, on top of that, a general anti-avoidance rule as well, I don't know, but that is the basis of this modern taxation. And I'm merely saying that that's the species of legislation that we've got here. And it's right that one should approach the construction of it taking on board that particular form of legislation. And there's a point that Lord Hoffman makes in his lecture and article, and I'll come to that later. But it is important to realise the kind of legislation we're dealing with and its purpose. And as I would say that when we look at the purpose of Chapter 2 of loan relationships, it is to prescribe, on the facts of this case, 3 loan relationships, to give one the particular debits and credits that the statute prescribes. And if there's something wrong, then there is a targeted anti-avoidance provision, paragraph 13, to knock down that which Parliament has determined to be the area that it could knock something down. And that was really the first point I wanted to make as a matter of approach towards construction. And the second point, and again I think I've already touched on it, is the complaint that my learned friends make on behalf of the revenue here is they say, well, your construction ends up with a very substantial debit for tax purposes in a transaction where your clients have made a profit, not a loss or a debit. And they say we ought to approach this legislation on the basis that its purpose is to give rise to a result that is equal to the economic profit. Well, I'm sure we'd all have sympathy with legislation that got us to the result that accorded with the economic profit. I've been saying to anybody prepared to listen, including the revenue, for the last 30 years, that the remedies open to the revenue as far as tax avoidance are concerned are really quite simple. All they've got to do is promote legislation that taxes companies on the profit determined in accordance with the general accounting principles in their profit and loss account. That's the kind of system you have in fairly sophisticated regimes elsewhere. Hong Kong, Singapore effectively have that kind of system. They have 100 pages of legislation.
They also have a general anti-avoidance rule.
Well, yeah, they do, yes. Yeah. But
that can save a few thousand pages of statutes, can't it?
Well, they existed. I mean, the anti-avoidance rule came in 1986, my lord. I mean, they existed before that, without any anti-avoidance rule that meant anything, at least. But the point I think I'm trying to make is that we haven't actually gone that route. If we had legislation here that said you are to be taxed by reference to the profit in your profit and loss account, it manifestly is a clear criticism if you don't end up with that. But Parliament hasn't chosen that route. Parliament's gone out of its way to go into these deemed hypotheses and fictional relationships. I mean, I'm sure your lordships would have seen what Mr. Justice Norris said about it in paragraph 22, and I won't bother to repeat that. But it hasn't adopted a system of taxation which is simply saying, we will tax you on the profit in your profit and loss account. It's gone about it by trying to create deemed flows of income, and the purpose of trying to create those deemed flows of income is to tax them as income rather than capital gain. And it may be that it's created too many of these deemed flows of income in this particular case. This is, I think I've already made the point. Section 730A does give you an answer which equates to the economic profit from the transaction. So 730A on its own achieves that result. It cannot therefore be said that the purpose of 737A and section 97 is to achieve the result that is already achieved by 730A. And it is plain that they are talking about different things, as we've seen. 730A is talking about the difference between the cash flows. 737A has gone out of its way to create notional income flows that certainly don't exist as a matter of fact. But the only purpose of creating those notional income flows must be that they are to create a credit on which somebody can be taxed and a debit on which somebody is entitled to a deduction. And those must be credits and debits in addition to any credit or debit arrived at under section 730A. And we'll also, just to perhaps look at this and what the judges below have said about the structure of the legislation. Mr. Justice Norris really deals with this in a number of the paragraphs in his judgment. It's paragraphs 8, 9, 21, 22 and 31. Could I just
ask you, I mean, trying to take a very simple, plain man's view, 730A works very well for the gross paying repo, and it taxes, as accountants say we should tax, the substance of the transaction. 737A and C, they're really just bringing in line with the general rule for the gross paying repo, the net paying repo, which is a bit of a hybrid because the interim holder is hanging on to onto the dividend and onto the coupon. Those two operate. I mean, really, 737A and C are just supplementing the general rule in 730A, aren't they?
No, my Lord, with respect, they are quite separate. I mean, as I see it, your Lordship was right about 730A, but as I see it, on 737A, they are trying to equate the net paying repo as if it were a gross paying repo.
Yes.
So as to create an income flow in addition to the one that is created under 730A. I mean, it must be an additional income flow. It's there as a completely separate income flow of credits and debits. I mean, as I see it, there has been overkill by Parliament in this particular case. And I mean, it's to the detriment, I suppose, of Parliament in this particular case. But the philosophy behind it was to create additional income flows in transactions where they didn't actually otherwise exist. And in my respect, submission, there's no doubt that 737A and Section 97 have created those income flows. I mean, the situation, it's actually exactly the same as the case my Lord Collins was concerned with in Bank of Ireland, where you had exactly the same challenge by the Revenue, by my learned friend, that there was a situation where the UK taxpayer was entitled to a debit of the whole of the coupon payable during the repo period, albeit that it wasn't taxable on 95% of the coupon in the repo period, because the coupon had been received by another non-resident. And that was, we'll have to look at the case, but that's looking at the consequences of Section 97 and 737A as creating those income flows. And we would say, actually, at the end of the day, the approach in that case is the approach which we would respectfully say should be followed here. And it would only be consistent with that case to get to the result for which DCC contends.
Would that be a convenient point at which to break?
My Lord, yes, I'm sorry, yes.
Well, we look forward to seeing you again at 2 o'clock.
My Lord, bless.